Construction contracts are the ultimate test of revenue recognition. How do you recognize revenue for a massive project that takes years to finish, especially when the final price might change along the way? Hello everyone, and welcome back to Accounting and Auditing Hub. I am your host, Suresh Periyasamy. Today we are putting theory into practice. We are going to apply the 5-step model from IFRS 15 and ASC 606 to a real-world, long-term construction contract. We will walk through the percentage of completion method, demystify the journal entries, and look at the financial statements. Let's dive in. Let's set the stage with our scenario. Our contractor, Build It Right Corporation, has signed a 2-year contract to build a custom suspension bridge for the Metro City Council. Here are the financial terms. The base price is a fixed $10 million. However, there is a performance bonus of $1 million if the bridge is completed 1 month early. At the start of the project, management estimates that total construction costs will be exactly $8 million. We start by running this through the 5-step model. Step 1. Identify the contract. The contract is signed, terms are clear, and collection of the $10 million from the city is probable. We have a valid contract. Step 2. Identify performance obligations. Building a bridge requires engineering, concrete, steel, and labor. But, because these are highly integrated to deliver one single output, we only have one performance obligation, the bridge. And skipping ahead to step 4. Because there is only one obligation, 100% of the total price is allocated directly to the bridge. But what exactly is that transaction price? This brings us to step 3. The contract has a $1 million early completion bonus. This is called a variable consideration. Under the revenue standards, we face something called the constraint. We can only include this bonus in our price if it is highly probable that a significant reversal will not occur later. At the end of year 1, there have been massive weather delays. Management estimates there is only a 40% chance of finishing early. Because it is not highly probable, we must constrain the bonus to 0. Our transaction price for year 1 is strictly the $10 million base price. However, in year 2, the weather clears up and the team finishes early. The bonus is achieved, and the constraint is lifted. Our transaction price officially updates to $11 million. Finally, step 5. When do we recognize this revenue? Because we are building the bridge on the city's land, the customer controls the asset as it is being created. Therefore, we cannot wait until the end. We must recognize revenue over time. To do this, we use an input method based on costs incurred. You likely know this as the cost-to-cost or percentage of completion method. Let's look at the actual math for year 1. During the first 12 months, we spent $3.2 million on construction. To measure our progress, we divide our costs to date, $3.2 million, by our total estimated costs of $8 million. This tells us the project is exactly 40% complete. To calculate our year 1 revenue, we take our $10 million transaction price and multiply it by 40%. We will book $4 million in revenue. Subtract our $3.2 million in costs, and we have a gross profit of $800,000 for year 1. Now let's translate that into journal entries. First, as we spend money on materials and labor, we debit an asset account called Construction in Progress, or CIP, for $3.2 million, and credit cash. Think of CIP as an inventory account for contractors. Second, when we build a city, we debit accounts receivable and credit a contra asset account called Billings on CIP. Finally, the revenue entry. At year-end, we debit our cost of construction expense for $3.2 million. We credit construction revenue for $4 million. And the difference, our $800,000 gross profit, is actually debited into the Construction in Progress asset account. Let's look at the financial statements at the end of year 1. Assuming we billed the city $3.5 million, but only collected $3 million in cash so far, our income statement clearly shows the $4 million in revenue and the $800,000 in gross profit. On our balance sheet, we have $3 million in cash and $500,000 in accounts receivable. But look at the bottom line. We have a contract asset of $500,000. Where did that come from? To understand that contract asset, we need to understand the bucket concept. On the balance sheet, you weigh 2 buckets against each other. Bucket 1 is construction in progress. It holds all your costs, plus your gross profit. It represents the total value of the work you have performed. In year 1, this bucket holds $4 million. Bucket 2 is billings. It holds everything you have formally invoiced the customer for. In year 1, this holds $3.5 million. Because the value of our work, $4 million, is greater than what we have billed, $3.5 million, the net difference of $500,000 is an unbilled contract asset. Moving on to year 2, the project is finished, and we earned the $1 million bonus. Because the project is now 100% complete, we must use the cumulative catch-up method. Our updated transaction price is $11 million. Multiplied by 100%, our total cumulative revenue earned is $11 million. We subtract the $4 million we already recognized in year 1, leaving us with exactly $7 million of revenue to recognize in year 2. In year 2, our actual costs were $4.9 million. For our final revenue entry, we debit cost of construction for $4.9 million. We credit construction revenue for $7 million. And we debit the $2.1 million gross profit into our CIP bucket. At the very end, we hand the keys over to the city. It is time to close out the project. At this exact moment, our construction in progress bucket equals exactly $11 million. Our Billings bucket also equals exactly $11 million. We simply debit Billings and credit CIP. This clears both accounts off our balance sheet forever, because the city now owns the bridge. Looking at our Year 2 financial statements post-closeout, our income statement shows the strong $7 million in revenue, resulting in a $2.1 million gross profit for the final year. Our balance sheet is incredibly clean. Because the project is done and fully paid for, we have exactly $11 million in total cash collected. Our accounts receivable is 0, and our contract asset is 0, because the CIP and Billings buckets were emptied during the closeout. And there you have it. Over the 2-year life cycle, we successfully recognized $11 million in total revenue, matched against $8.1 million in actual costs, resulting in a perfectly balanced $2.9 million total gross profit. Mastering the percentage of completion method and understanding how the CIP and Billings accounts interact is absolutely critical for your CPA exams and for anyone working in the construction industry. If you found this breakdown helpful, please hit the like button and subscribe. If you are a student or professional looking for one-on-one tutoring to master these complex standards, you can reach out to me directly at the email on screen. Thank you for watching, and I will see you in the next masterclass.